course. We've got a very low budget, $20 million to get it going, so it's very low capital, and it's got good economics. 210 million US NPV and 130% IRR, 19 months to pay back, and low operating costs. So, anyway, keep an eye on us. We're on the web. Thank you. Cheers.
Thank you. Okay, up next we have James McDonald, the President and CEO of Kootenay Silver. James is a professional geologist with over 30 years of experience, and in 2000 he co-founded National Gold, which was later merged with Alamos Minerals to form Alamos Gold, for which he served as a director and on numerous committees until June 2012. So welcome.
Thank you. Okay, hello everybody. So Kootenay Silver is an exploration discovery company and now developing some resources. We have 3 discoveries we've made in Mexico: Promontorio, La Negra, and La Cigarra. Forward-looking statements we're going to be making here about what we believe is coming in the future. And investment highlights. So we've established here through our discoveries in 2 deposits 140 million silver equivalent ounces in the measured indicated category in Mexico. The 3rd discovery does not yet have a estimate on it, but there will be one coming from our partner this year. These assets make us a top-tier junior company in terms of silver assets, and particularly in Mexico. We've got tremendous resource growth potential on all these deposits, and a potential future cash flow deal with our partner Pan American Silver on the JV deal we have on Promontorio La Negra. Lots of discovery upside on the recently acquired La Cigarra deposit that we bought last year for 20 cents an ounce in the ground. We picked up another 62 million ounces of silver in that deal, and a good capital structure. We're following this model that I was involved in with Alamos Gold. Basically, we bought an out-of-the-money gold deposit back in the year 2000, and as the gold price recovered and that deposit was developed into a significant producer, the market cap went from a $35 million market cap to $2 billion during that course. So with La Cigarra, we hope to follow a similar pattern where we take this resource, prove it to be economic, grow it, and in a rising silver environment, see significant gains in the value of the company. This year is a lot of work going on coming up here. We've got 15,000 meters of drilling that we're drilling on the La Cigarra deposit itself. We own 100% of that deposit without any royalties. We'll be drilling off the deposit, which is open in 3 directions, and drilling some peripheral targets that haven't been looked at yet. On the La Negra Promontorio project, that's being handled by Pan American Silver, and they're going to be drilling there in Q2 and Q2, and putting out a maiden resource on our La Negra discovery. And then we have some other joint venture deals on our early grassroots generative projects. So here we are. Our main projects are in northern Mexico and Sonora State and La Cigarra. La Cigarra there, 51 million ounces of silver M&I and another 11.5 in the inferred. And at Promontorio, there's 92 million ounces silver equivalent in the original discovery. And again, La Negra does not yet have a resource calculation. That's expected this year from our partner. La Cigarra, we're quite excited about that. We think that resource is going to grow a lot. And the reason we think, there's 2 basic reasons. One is the geologic context. We've got a very underexplored 18,000 hectare land package in the Parral mining district of Mexico. That's one of the premier and most prolific silver producing districts in all of Mexico. The history here goes back over 500 years. So 500 years of finding deposits, mining deposits, and replacing those reserves and finding new deposits. You see La Cigarra in the red there, and to our immediate south, 5 kilometers away, is the San Francisco del Oro mine and the Santa Barbara mine. Those mines are still producing today. In fact, Grupo Mexico at Santa Barbara is producing down to depths of 1,000 meters. The La Ciguera discovery was made in 2012 and is right at surface. So we're literally scratching surface here. And that region to the south of us produced over 800 million ounces of silver. So you're in this great prolific district with a brand new discovery at surface, numerous targets, open-ended deposit. This is one of the reasons we are so bullish and excited about the growth prospects of this project. The deposit itself here, that's a block model of the deposit. It's open on both ends there, to the right and to the left, wide open. Going to the left, to the south, there's no other drill holes at all for at least 800 meters. So starting in about a week's time, we're going to be begin drilling off the ends of this deposit, starting on the south end, which is your left-hand side, and then going to the north after that. Then in about August, we'll be looking at some of these peripheral targets, of which there are 11 identified to date outside of the current resource. We're prioritizing those, doing the mapping, putting a priority to them, and in August we'll begin a second program of about 7,500 meters aimed at testing these various targets peripheral to the deposit itself. So we want to end up at the end of the year with having defined the size of the current deposit, do a resource update at that stage, and then put a timeline on a PEA, preliminary economic assessment, and then have drilled some of these other peripheral targets and hopefully made a new discovery. This is over a 7-kilometer long trend here that you're looking at, so it's a tremendously large mineral system we have. Back at Promontorio, where we made 2 discoveries there, Pan American has optioned that. It essentially gives us a 25% carried to production deal. They have to spend $8 million US in the ground. They have to pay us $8 million US in cash over 4 years. They're in the second year of the deal. And then they earn 75%. After that point, they have to supply all of the capital going forward, right to mine production. And they get to recover our portion of that from 60% of our cash flow at the end, but we don't have to put any money up. And what got them particularly excited on the project was the large resource at Promontorio you see in the upper part of that image there. But then we made 2 years ago a brand new discovery right at surface called the Negra, where another breccia system, where we're getting some just tremendous drill hole results out of the first couple of phases of drilling. You can see some of them there, 420 grams over 50 meters, 156 grams over 200 meters, for example. 1,300 grams over 6 meters, some really nice values. So they saw this opportunity here for this the deposit, and further for Pan American. South of this project, they have a mine called Alamo Dorado, which is running out of ore and is now today, in fact, out of ore, and they have a 5,000 ton a day plant and leach circuit there that they could use at this, bring up to this site and use here. So they're working to get this deposit large enough to justify that. So the capital structure you can see here, 174 million shares issued. Daily volumes pretty good, nearly 300,000 on average. We've got 4.8 million cash in the treasury. The drilling program I talked about on La Ciguera is going to cost us approximately $3 million. These are Canadian dollars. The share structure is very interesting. We've got really good shareholder interest and holdings in support in Europe, especially. KTN Institutions, that's mostly out of there, 35%. Then we have Pan American owning 10% as part of the deal they cut with us. They have the right to maintain that interest as well. Coeur came in and invested based on the North Air La Ciguera discovery, and Agnico came in based on our initial discovery at Promontorio. And then the board and management is very well rounded, I think, especially for a junior company. We've got excellent experience right from the grassroots prospecting discovery stage up through the development and building and indeed operating of mines and financing those projects along the way. So just to back up here and close out, we've got, again, we've got this great silver bank base with our resources and the 3 discoveries we made. So we got this strong potential for a value re-rating as we advance those projects towards a PEA. Significant leverage, obviously, to the silver price. There's 3 drill programs happening in different phases this year on La Ciguera and the La Negra Promontorio project. And then we're looking towards a resource update for La Ciguera at the end of the year and a maiden resource on La Negra. And, of course, now there's a pathway to production we have with the Pan American deal. And we also have a large portfolio of early-stage projects that we option out to joint venture partners that hold potential for brand-new discoveries. And I think that brings us to a close. And if there's any questions or further interest, come to see us at Booth 7.
Okay, we have one more company presentation ahead of the much anticipated panel discussion. So Cycladex, Roger Petman, the founders here with us. Thank you.
Thank you very much. Go to the slides. Okay, just to look at the I formed Cycladex 3 years ago, and this is the team that's with me. Sir Fraser Stoddart won the Nobel Prize for Chemistry last year, and it's his technology that I licensed from Northwestern University. Dale Arnold is a chemical engineer from DuPont with 35 years' experience, and Leven helps me with the business development. So Cycladex is developing a new process for actually isolating gold, silver, platinum, and palladium using a cheaper process than cyanide and also an environmentally friendly process. This slide looks like slightly complicated, but it's actually relatively simple. What we do here is we take hold of gold bromide in water, and then we add that with, it's called alpha CD. It's just a sugar. It's in a lot of cosmetics. It's very cheap and commercially available. And when you mix those 2 together, then you get this nice complex, and the gold crystallizes out in extremely high purity. We've tried this in the presence of copper, zinc, platinum, palladium, and it's highly selective. So it's an excellent method if you've got a gold-copper mixture. We can separate these 2. So moving forward, we were successful in getting $1 million grant from the National Science Foundation. They only fund about 4% of all applicants, and we were delighted that Comstock Mine, based out in Nevada, became a strategic partner with us. And the process which we're developing, it's just the same as the cyanide process, but just with one twist. So all we're doing is we're taking a crushed ore. This works well with either a heap or a vat process. And then we use our lixiviate. And the lixiviate is composed of effectively an inexpensive salt, hydrogen peroxide, and some acid. And you can then actually make the gold bromide, and we can also separate out the mixed metals. This process is very good for silver, platinum, and palladium. What we do then is we do a filtration, very similar when you go through a clarifier. I'll show you next on the cyanide process. And then we just crystallize out the gold and filter it off. So you end up, even with a silver-gold mixture, you end up with 99 gold, and you can separate the silver out as well. And then we then recycle the lixiviant, so you're not going to end up with these huge cyanide tailing dams. And we're in a process of scaling this up now. Just have a look at what the actual process, just to show you some of it. So we've been working with a wide variety of different companies around the world, because the first question came back is, okay, well, it works well on the Comstock ore, but where does it work elsewhere? And as you can see, we've pretty been much right around the world now. We're working with 10 mines, and we'll come on to that. It also works well with quite a few refractory ores as well, so you don't have the problems that you do with cyanide. So this is what, if you look at this is just a simple cyanide process which you're looking at. And what we're looking to do here, we can actually retrofit this process into an existing cyanide plant. So what you have on the left is you're doing extraction. You go through a clarifier. And then the only change which we have is actually in green, where we're just going through a concentrator, which is just a simple osmosis unit, which you can buy off the shelf. and then we do the crystallization of gold. And we worked it out in a 500-gallon reactor. You can actually put over $1 million of gold. So there's not a huge amount of capex involved. So this is what we're looking at now. We have a pilot plant. We're moving now to scale this up at the 1 metric ton per day. We have a company in Russia who's already built a pilot plant and scaling that up. We're also scaling up to the 400 metric ton, looking on a heap as well. The plus part about our processes is that, especially when you look at a heap process, we can now look at an on-off pad. So you can put a certain amount of ore on a pad, do the extraction, typically in 30 days with our process compared to 90 days with the cyanide process. So you're getting a threefold increase in throughput through your existing plant. And then once you've done the extraction, you can then take that ore off and then put it back, use it for backfill, or in some cases, some people are looking to see whether they can use that material for construction. So here, you're looking at what is a cost and a waste in terms of an asset on the balance sheet. So how does it compare with the cyanide process? We have very high extraction efficiencies. Typically, we get 3 to 4% better in terms of overall yield of gold and silver, but it's the time which is key. So you have to look at how, if your plant is becoming a rate limiting step, then you can put a significantly amount of more product through your plant, and of course that will then reduce your fixed costs and reduce the cost of actually producing gold. Our chemicals, we looked at the cost. We're around about $1.75 a gram compared to cyanide, which is typically $4.50. So significant decrease, not only in the cost, but also the volume of chemicals which you're looking to move. And next thing we're looking at is actually what's the carbon footprint reduction on that as well. The waste products, as we said, there may be a small amount of salt, but very small. But all of those are actually recycled. So it's coming almost to a zero waste situation. CapEx should be significantly less expensive. We think it's going to be, if you look at a new plant, about 35% less CapEx, primarily because 35% of the plant actually goes into destroying cyanide, which you put in. Here, of course, we don't have that problem. As I mentioned, the spent ore can be used, and then, it's the faster metal dissolution, which is the key thing. So our marketing goal here is that we're talking about a much quicker, cheaper process, which has the benefits of being environmentally friendly. So it's we don't think it actually compares to the old costly cyanide process. What's our traction in terms of the market? We're just starting out on this now. We're working with 10 mines from 9 countries. We've all had these samples through, and they've all worked very well. With Comstock, we're going to go to a 400 metric ton leach, which is kind of like a midway through. We've already done the standard 60-kilo columns and got excellent results. We're on ongoing license discussions with 3 companies, one of them in the FTSE. Our business model is actually a licensing strategy. So we're going to look at taking a license on the gold produced. And most of the miners we've talked to are very happy because they're getting a significant reduction in cost as well. So it's really the cost which is driving everything through. We're looking at retrofitting an existing cyanide plant which is in Indonesia. We're also now looking at European approval. We're working with a company called Ortat Resources in Slovakia, where cyanide is banned. We're working with a Slovakian institute, and our plan is to actually put a mobile plant in Slovakia and start processing the ore. And this will be the first time we'll get European approval. And once with European approval, we think that should actually stimulate other business going forward. The process is patented by strong patents, so we've patented worldwide in all of the top gold-producing countries. And we've followed up with a second patent as well. We have a very good position with all of the fine chemical suppliers, and the supply chain is already in place. Where we are at the minute is we're just currently on the road with Scott Macon, and we're looking at raising around about 7.5 million shares at a pre-money valuation of $15 million. So in summary, where we feel now is we feel very comfortable that we've sorted the process out. We're very comfortable with with the potential of it, and we're also getting extremely good traction from the marketplace. So thank you very much.
I'm going to invite our final panel of the day. I don't think so.
Which seat's got the electric phone?
I wouldn't sit in the second chair. I'm kidding. I'm kidding. Hello. So, Adrian, I'll walk you to the stage. I have the pleasure of introducing Adrian Day now. He's a good friend to Kitco News. He's a graduate of the London School of Economics. Very impressive, Adrian. Just read that in your bio now. He heads Adrian Day Asset Management, and he will be moderating this fantastic panel, so enjoy.
Yeah, well, thank you, Danielle. Sorry to disappoint you, Danielle, but I didn't graduate from the London School of Economics. It was the London School of Economics. Sorry. So funny. So I'm really looking forward to this last panel. I hope, I'm assuming everybody else is. I think we'll introduce the panelists first of all. Let's see. On your right is Mike McClone. Unfortunately, Peter Hugg, I'm sure you've been told Peter Hugg couldn't be with us this afternoon, but at the last minute, Mike took his place. Mike is a senior commodity analyst at Bloomberg Intelligence. He joined them about a year ago, but before that, he has 25 years of experience futures and commodity trading. Next to him is my good friend Rick Rule. Rick, I'm sure most of you know, is the founder and chairman of Sprott U.S. Holdings, wide and deep and long experience in the resource sector, including not just gold, but including alternative. Oh, I'm surprised you mentioned alternative energy.
I have a lot of experience, Adrian, not much good.
You have a lot of experience. Agriculture, forestry, oil and gas, as well as mining. Vance Lancy is the founder of, next to him, is the founder of Echo Bay Partners. Again, a lot of experience, 27 years experience, trading precious metals primarily. He's retired from active trading and now manages his personal investments through Echo Bay, the Echo Bay entity. And then lastly, on my immediate left is Todd Bupper Horwitz, who's the chief market strategist for Bupper Trading. Many of you may know him, in fact. He has a daily podcast called The Bubba Show. He has a daily 60-minute radio broadcast with the same name, specializing in news and also, and this is something to my heart, also educating investors. I think it's so much more important than just, as Rick likes to say, don't give them the fish, but teach them how to fish. And Todd also, in addition to the media career, concentrates on education and training of would-be investors. Now, when Andrew asked me to moderate this panel, he said that you get to speak for about 30 minutes and then you have followed by a panel. Frankly, with this esteemed panel up here, and I can see the look on all of your faces, I don't think anyone wants me to talk for 30 minutes. So I will give a brief introduction, and Rick, who is a very, very good friend of mine, when I begin to go on a bit, you just say something, Rick, okay? And I'll stop.
Should we do it preemptively? I mean, this is certainty.
No. So the topic of this panel is gold under Trump. And I might disappoint some of you, but I have no snide or supercilious comments to make about your president.
You're not the fake news?
What? No, I'm not making any comments about the president. I'm talking purely about gold as an investment under Trump. And we'll begin with a quote. It was the best of times, it was the worst of times. It was the age of wisdom, it was the age of foolishness. It was the epoch of belief, it was the epoch of incredulity. Some of you may recognize that. So what we're talking about today is the tale of two Trumps. We're going to look at the two Trumps and their policies and the possible effects, and we're going to look at the impact of these two Trumps on the price of gold. You know, in my view, many of the goals that President Trump has, particularly on the economic front, are quite positive. The difficulty, perhaps, shall we say, comes in the details and in the carrying out of these policies. But first of all, for example, the president has said he wants to cut federal government spending. I'll add a sort of, because as we know, he wants to increase the military spending tremendously. He wants to increase spending on household security, on what's called homeland security. And as you can see here, 2/3 of the budget is entitlements, another 6% is debt interest. So if you're going to increase defense, there's not an awful lot left to cut, number one. Number two, as we've seen, when you do look at cutting some of these other things, you have a great deal of difficulty getting them through Congress. Because, in Congress, it's so much easier to say, well, look, I'll agree to your spending if you agree to my spending, rather than the opposite way around. I'm going to cut your spending, and you're allowed to cut my spending. So it's much more difficult to cut spending. We know that. We've seen that many times, and, of course, we saw it with this budget. When it was first given to Congress, I frankly couldn't believe some of the things he wanted to cut. And, of course, when it came out of Congress, none of those things were actually cut. But if we do cut federal government spending, that's obviously a good thing. The second thing he wants to do is to cut and simplify taxes, and that, again, is a good thing, or would be a good thing. As we know, the U.S. corporate tax rate is one of the highest in the world, exceeded only by Puerto Rico and the United Arab Emirates. So cutting that corporate tax rate would be a good thing. Doing something for flow-through entities, which are most small businesses are set up as flow-through entities. Doing something for those would be very positive. All I'll say is let's just wait to see what actually comes out of Congress, because I think all of us here would agree, we recognize that whatever President Bush gives to Congress is going to be a long way from what comes out of Congress. But again, a second good goal. A third good goal from President Trump, I'm looking at the best of Trump at the moment, is to cut stifling regulation. Regulation in this country has just absolutely grown amok. It obviously, in our industry, in the investment sector, it is particularly onerous, but it affects everyone: the health food industry, the medical industry, and so on and so forth. Medical sector. And President's made a very good start with some of the people that he's hired, people like Carl Icahn and so on. But, again, let's see what happens. Regulators do not give up easily. And one of the biggest problems with regulation today, it's not what passes Congress. If we're talking about something that's in Congress, like Dodd-Frank, we can go to Congress, we can try to change it or eliminate or abolish it or reverse it. But what typically happens is, and you saw this with Dodd-Frank, in his 1,000+ pages, gives these broad outlines of what they want to happen, which then goes to different agencies, which are mandated with coming up with the rules and the regulations. So the SEC is mandated with coming up with the rules and regulations that affect the brokerage industry, that affect the registered investment sector. I'm a registered investment advisor. And at the end, the beginning, I should say, at the beginning of 2016, an outside compliance firm I used, in a recap of 2015, said, well, the SEC put out, are you ready for this? The SEC put out 385 new regulations last year for registered investment advisors, all of them from the Dodd-Frank. Now, the truth is that 385 regulations don't affect my business, they affect somebody's business, but we've got to read them all, we've got to think about them all, we've got to talk to our attorney about them all, we've got to decide whether or not they apply to us, and this is very, very time-consuming for small businesses. It's also extremely expensive for small businesses. And that was just for registered investment advisors. Brokers have it even worse. Mutual fund industry has it even worse. Regulators do not give up easily. And the problem is that even if they change something in Congress, as I say, it goes from Congress to the agencies who then come up with these rules, and then it goes to what I call the compliance industry, which magnifies the SEC's intent, tenfold, because they want to be super safe about things. And so even if you overturn a rule in Congress, I think it's going to take a long time before, in the trenches, if you like, we see the effect of less regulation. But certainly that's a very important thing. We can look at this graph here since Dodd-Frank came in, and look at how the number of new businesses that have been created in the US each year. And the number has absolutely collapsed. And it's not a coincidence. There's more businesses in the United States closing each year since 2007 than there have been starting. And this stifling regulation, along with some of the other things I've mentioned, is one of the reasons, of course, that we've had such a tepid recovery compared with other recoveries. And I know some of the people on the panel, we all know a lot about this, but I'll just give a few examples. This is growth. You should have a sharp recovery. You should have some kind of multiple years of 4% growth after coming out of a recession such as we did, and we just haven't had it. You can look at other things, business investment, very, very sluggish. A lot of reasons for that, but one reason is certainly the regulation, and then this shows the average weekly earnings that have recently started to go down. So there's no denying that this has been a very, very tepid economic recovery from the 2008 crisis, when the numbers should have been a lot stronger. Since President Trump was elected, or Trump was elected president, I guess, there's been a jump in optimism. This is the U.S. Economic Confidence Index, and that jump is even more pronounced among small businesses. And as I indicated, small businesses really, they're the engine of economic growth. They're the small businesses as a group are the creators of more new jobs than big businesses, but they have really been hurt in the last decade by taxes and by particularly by regulation. So confidence is up on President Trump. And the stock market, of course, is up on President Trump since his election. So it seems like business owners, it seems like the stock market believes that we're going to get the best of Trump, the things that I've just mentioned. And if we do get the best of Trump, then likely the economy will boom, the stock market will zoom, but not so much gold. But are we likely to see that? And I'll just say a few words about what we might call the worst of Trump. Didn't have to look long for that picture. The first thing that I'll call the worst of Trump relates to these two gentlemen here. Some of you may recognize Mr. Smoot and Mr. Hawley. And I'd like to know, where did they come up with names like that? Does anybody in this room know a Mr. Smoot? But anyway, protectionism, whatever we think about jobs going out of the US, whatever we think about workers who are displaced by new technologies and by cheaper goods from overseas and everything else, the plain fact is that protectionism is bad for the economy and it will be bad for the stock market. So if President Trump, in my view, gets his way on this, it will be bad for the economy and stock market, perhaps good for gold. The other thing relates to that swamp. We can have all sorts of good intentions, such as I mentioned earlier, but they get bogged down in the Washington swamp and they don't come out the way we intend. And we saw that with Obamacare reversal. Some reasons for that, of course. I mean, it was a little hasty. We definitely saw it with the budget, with all the back and forth, and we actually had all the spending cuts added back in. I, as a libertarian, fully understand President Trump's frustration and his comment, or his tweet, I should say, that what we need is a good government shutdown. I'm surprised that one didn't get more publicity, actually, but the president says we need a good government shutdown. One other factor I'll talk about that's quite important. Sorry, we'll skip over this because we talked about the dollar earlier at the earlier panel, and that is inflation. If President Trump is able to overrule or overhaul most of Dodd-Frank, and more particularly get the regulators to back off the banks, we will see the banks lending more money and having less money on deposit. This graph here, you can see it's up, down, and we've had a strong recovery, of course, from the 2009 recession, but bank lending is still way below where it was in the early 2000s, and is particularly weak, again, to small businesses. So, and that's because banks, frankly, are afraid to make loans to risky small businesses because they've got the bank regulators breathing down their necks. If President Trump is successful in getting the banking regulators to ease off a little bit, then the banks will start lending more money. And as was mentioned earlier, all the money that the Federal Reserve created in the last 7 years still exists. It hasn't gone away to money heaven or anything like that. So if the banks take their money off deposit at the Fed, start lending it out, and start leveraging their lending, of course, then we will unleash the price inflation that has already been created. The inflation's already been created over the last 10 years, but we will unleash price inflation. We're already seeing price inflation even before President Trump. And as a political comment, if I may, I can guarantee you that if we have high inflation in the US a year from now, everybody will be blaming President Trump. But you can see that from the bottom last year, with numbers of 1, under 1, just over 1%, we're now up at, last month we were up at 2.9%. So we've already seen a dramatic increase in inflation, which had nothing to do with President Trump. But if he is successful with the banks, and the banks do start lending more money, that will only, in my view, unleash much higher inflation. And I'm nearly at the end, Rick. I can't see your comments to me, but anyway. When we talk about inflation, a lot of people say, well, you know, the Fed's going to raise interest rates, so not to worry, we won't have inflation. As everybody knows, and as was pointed out earlier, it's not a matter of interest rates going up, it's a matter of real interest rates going up. And at the moment, the Fed is lagging, let me jump over that one, the Fed is lagging inflation considerably, and I think the Fed will continue to lag inflation. Now, the question has been asked, can gold go up if interest rates are going up? That's a good question. Well, they can, again, if the Fed is lagging inflation. This is a graph from the second half of the 1970s, when you can look at the federal. This is the federal funds rate. I don't know what happened to my gold graph. But anyway, this is the federal funds rate graph. You can see federal fund rates were going up and going up in an accelerating pattern in the second half of the 1970s. And yet those of us who were around at the time, or those of us who have read history books, know what happened to gold in the second half of the 1970s. It was a remarkably good period for gold, going from, at a bottom, $100 or $101 or something to $850. So gold can beat higher inflation rates. And another more recent example is this one from Bloomberg. Don't sue me, will you? But I did give you credit. Which shows an increase in the Fed funds rate from 2004 to middle of 2006, but it also shows how gold was able to go up, particularly at the second part of that period. So the point I'm trying to make is that gold can go up even if interest rates are going up. And the other thing, this is a graph I borrowed from my friends at Incrementum in Liechtenstein, and if you don't get their research, I recommend it very, very highly. He makes a very important point. Inflation cannot be controlled like a thermostat. And you can see how in each of these periods here, 1915 to 1917, 45 to 47, and 72 to 74, we had low inflation, and 2 years later, we had double-digit inflation. Inflation tends to accelerate very, very rapidly once it gets going. That is the point. So what we've seen from last June, inflation in the U.S., price inflation, I keep saying inflation, but I really should say price inflation. Price inflation under 1% up to almost 3% in less than a year. I would say that the risk of looking at double-digit inflation a year or 18 months from now is actually quite high, and that would also be positive for gold. So just to summarize, when I talk about the best of Trump and the worst of Trump, some of these are factors outside of Trump's control, some of them are not. If we look purely, if we only get the best of Trump, lower taxes, lower government spending, simplified taxes, because that's another important part of the tax equation, and far fewer regulations, we would have a very strong economy, very strong stock market, and probably a strong dollar, even though he doesn't want that, and a weak gold market. If we don't quite get all those good things quite as good as we want them, but we do get protection, or we do get higher inflation, then I think we're going to have a very, very strong gold market. I haven't looked at other factors. There's many other factors, of course, geopolitical factors. These geopolitical factors existed before Trump became president. One might argue he could be he could be the spark that ignites some of them, but certainly he didn't create them. We can look at Europe, where let's not imagine that the populist movement in Europe is all over. We have an election, the final election in France next week. We also have these Brexit negotiations where it seems as though Europe wants to do its best to punish Britain, and those are going to be very contentious negotiations. There will be a negative for Europe. We have negotiations with Greece where they're, the debt package has run out. They need to renegotiate the loans to Greece. That comes over the summer ahead of the German elections. I don't know how friendly some of the German politicians are going to want to be towards Greece immediately ahead of a German election. So let's not forget about Europe at the moment. There's a lot more coming. And don't forget, the last time Greece needed money from Europe was in August, September of 2012, and we remember what happened to gold at that time. So, best of Trump, worst of Trump, I'm not quite sure. I don't think it's going to be quite as good as perhaps some of us hope. So, well, that was a little less than I was given time for. Is that all right, Rick? Okay. So I've got a few questions for our panelists. We're also going to open the questions up after we've had a few questions from the panelists, and we'll open the questions up to the floor. So I hope everybody is thinking of questions they want to ask. But let me start, and perhaps I'll ask everybody this one. Some questions I'll only ask one person, but I'll ask everybody. I mean, gold is an investment in a Trumpian world. Do you think Trump is a positive, a negative positive, or a negative for gold, or basically is he irrelevant to gold? And was my speech a waste of time?
Well, I think that he's a non-event for gold. I think the biggest problem we have is the central banking system throughout the world. We don't have true free markets in this world anymore. There is no longer the true price discovery model. Every price is manipulated by what the Fed decides to do with a dollar, or what Germany's Fed, what Mario Draghi does with their dollar. In the meantime, gold has had some nice appreciation recently, and it looks like it wants to make its way higher. And as a hard asset, I think gold is something that's going to continue to increase in value, you know, from a investment standpoint. So I personally would be a buyer of gold anyways. But the first thing we're concerned about is whether or not we're going to have free markets to be involved in. Because so far, since the recovery, which has not existed, there's no growth, we still have a recession, nothing has really improved for the average guy on the street. So if we look at it from that standpoint, whatever Trump does can only be better than what we've had in the past, because at least he's trying to run the country like a business, which would maybe allow the movement of free price discovery and free markets.
Sorry to hear that. I don't think that who the President of the United States matters when you're dealing with secular trends that cannot be changed by one person in power. And by that I mean government, and you should always be careful of someone who uses superlatives like always and never. Government cannot change the direction of secular trends. It can only speed up or slow them down. And that's actually a hat tip to some of the things that you said, in the sense that Trump may speed things up, he may slow them down. But it is my opinion, and it's really not far off from what Todd is saying, that there's basically an iceberg, and it doesn't matter who's piloting the ship. We're headed towards the iceberg, and that's debt, or the only way to get out of the problem is through deficit financing, pot odds, or how things are going. So with regards to Trump as an effector on the price of gold, I don't know, and it will affect us day to day, week to week, month to month. But my view is, and my actions are longer term, and I think I'm not saying $5,000, $10,000 gold, but I think you would be remiss if you thought that we could just the person in power could just change everything. The trends are in place. They're not going to reverse overnight. We have no organic growth as a country, very little. It's not to say it can't change, but what we have is a situation where, if you want to compare Trump to Reagan in terms of let's add debt to get things going, well, we already have that. I don't see how the U.S. dollar is not debased in an effort to lower and slowly default on our own debt. Now, there are ways out of this, but we cannot have, I believe, if the Fed were to raise rates, for example, whether it be Trump's doing or not, I believe that they have to chase inflation. And you have to have negative real rates on the way up. So you could have 10% interest rates, but your real rates are negative. So that would be positive for gold if that were to happen. I believe that would happen, because if real rates were to be positive, then you'd hurt the stock market. You would hurt the potential for organic growth. So I don't think Trump is a non-event. I think he's an accelerator or decelerator, depending on what he tweets that day. But I believe that there's an iceberg ahead of us. I mistakenly thought the QE events were that iceberg. It's the unwinding, or the fact that we have to continue to add down the road that are the major factor domestically.
Rick?
I think that Trump is useful to gold in a narrative sense. Gold seems to do well when people are afraid, and Trump makes at least half the electorate terrified. So he's useful in the context of a narrative. I agree with the prior two speakers that he, as a person and as a president, is irrelevant. My own limited experience watching politicians is that sometimes they can win 1 or 2 fights, but somebody who picks 50 fights is screwed. And his probability of getting all that done is sub-zero. The other thing that I think I'd like to say is that what Trump represents is probably good for gold, in the sense that the solutions that his people ask for amount to stealing from the unborn and given to the rich or the useless, just like what Obama represented was good for gold, in the sense that you steal from the productive and give to the unproductive. What I'm trying to say is that both presidents, as individuals, were sort of irrelevant, and the trends that got them elected, the things that made them popular, were in both cases good for gold. I say that in a very sad sense because I'm American, that I'm always conflicted as a gold owner because I own gold for insurance purposes. And the thing that makes that holding in my estate worth more makes my life less pleasant. My supposition, unfortunately, is that insurance might come in handy. And if you think about gold as an insurance policy, any of you who own insurance policies, think about what happens to get paid. Life insurance assumes somebody dies, stuff like that. And that's sort of the way that I regard my gold. So in that sense, I think that if Trump accomplished his goals, as an example, if he stole on behalf of less productive working people in the United States who can't compete with cheaper Indian labor, if he was able to steal from the unborn to put $2 trillion worth of infrastructure in place in a country that's already $20 trillion upside down. I mean, think about all the stuff he'd like to do with other people's money. I suspect if he was successful, which I don't suspect he will be, in other words, if his will was done, I think it would be, sadly, good for gold.
Yes. This is a question, right? I can't see how he'd be anything but good for gold for 2 main reasons. I have to agree with you, Rick. It's number one, uncertainty. I mean, I just came back from Europe last week, so I had to relearn how to say aluminum. And I've never heard of a president really talk down the dollar. I mean, we remember days of Robert Rubin, strong for the dollar. So we know, from my analysis, some of the things that you showed from the Bloomberg terminal, I look at gold as what's the main things that really impact the price. So in Europe, it's not so much the dollar price, it's different currencies. But here, it's the dollar price of gold. And the number one thing historically is the value of the dollar. It's how you measure the dollar. Right, so I look at the Bloomberg Dollar Index, and I've been looking, so you look at what gold has done since Trump has been president, it's down about 2% as of today. So as of last week, it wasn't. The dollar index is up 2%. That's actually a good sign because generally gold declines more, has a higher beta, negative beta to the dollar. But the stock market's up 10%. And to me, that's the key thing. That's keeping the Fed on the trigger for tightening the stock market up. Trump has helped produce that. But gold, despite that, is still showing divergent strength. So let's look at last year. Gold, again, recovered despite dollar strength and a recovering stock market. That's a pretty good sign of a divergent bottom. So I look at it, what's it going to take for gold to go down? Trump is a good factor, and what it's going to take is the stock market to go up another, who knows what, 10%. Trump might help that. Volatility is another key reciprocal to gold. Let's look at the VIX. If the VIX goes up, what is that usually good for gold? If Trump can help that happen, maybe that's not a negative. You look at the 26-week average of the VIX, it's the lowest in 10 years. It's the lowest before the crisis, which was the lowest in history. Okay, so what does that mean? It's only one way for that to go. It just might take a while. And then you look at the dollar. Despite the fact the Fed has started to tighten, we had 3 tightenings. Now, Trump's not going to really fact that. The dollar is down 1%. Why? Because people bought the rumor. 21% for the 2 years up until the first hike, and it's been declining since. Now I'm using the Bloomberg Dollar Index. So what's it going to take for the dollar to go higher? More an aggressive Fed tightening. Now I don't think Trump's going to be a factor there.
He didn't want tightening.
Well, that's the point. So that's part of it. Everything I see from Trump is somewhat bullish for gold, except the fact the stock market's still going higher. Once that stops, I didn't say if, it's always reverts. Volatility cannot stay low forever. It always mean reverts. It's the first really rule learn in the options trading pitch is volatility is always mean reverting. I'm worried about. I'm more worried about gold continuing to do what it's been doing, recovering. And it'd be wonderful if we still have those things that pressured it the last few years, but I just can't see historically how they can be sustained. And I don't know is Trump's going to help that or not.
Okay. Well, it seems like we seem to agree. Todd, let me ask you, do you see inflation as a possible risk in the next couple of years?
Well, it really depends if it's real inflation or if it's directed by the Fed. I mean, in their goofy world of stealing my money, they want to raise my asset prices so I can pay more taxes. But if we get true, real inflation where we see real price discovery and actually it's meant from supply-demand versus Fed-induced, then I think you'll still have gold that will work its way higher. But I don't think we'll see that type of inflation. I don't think we've gotten to that point because we still have no growth in this country. We can look at the graphs all we want, but at the end of the day, prices are approximately the same, except incomes are lower, and we have a big problem with debt and jobs. So I do not see, unless the Fed can get their way to induce more inflation, because there's nobody who's got enough money to go out and buy it. And you tie in your views of the regulations. The regulations are a total joke. They destroyed every small bank in this country. They don't allow the small banks to exist in the world. And because when the regulators come into a small bank, the small banks are shaking in their boots and they got to pay the fine. And when they go to JP Morgan goes out to go stick it up and they pay their fine and move on. So that's the issues that we have all the way around. And we won't, until we get through and allow the markets to discover price and allow the markets to fail, because they're going to fail. I mean, right now we get 5 stocks pushing the stock market up. That's what we have. There's no longer, all these stocks. You got the 5 big tech stocks that are driving the market. So, at the end of the day, until that resolves, that we won't see real inflation.
Okay. Do you agree with that?
I think self-clearing markets are an endangered, if not extinct species. And if we would have some self-clearing situations, as disastrous as that could be in the short run, it would be healthier, I think, organically for the economy. Okay. There's a lot I agree with.
Now, Vince, you've talked I've seen some of your interviews and so on, you talk a little bit about geopolitical events. How big a factor, first of all, in general or in principle, how big a factor do you think geopolitical effects are on the price of gold? And how do you see where we are now? Perhaps I should ask the question more pointedly. Why hasn't gold gone up more, given that the president bombed Syria and then is tweeting about a big war with Korea? And it could be a big one. Huge, even.
Can I take a break? No, I'm sorry. Mike's comments about Europe and I think you were alluding to stress and uncertainty. I think the geopolitical problems that are that we're more aware of now, or that are coming to a head, are being factored into the price of gold. That is why you are seeing gold hold its own relative to a strong dollar, and that we'll come back to that, because the real question is, how can you quantify what is dollar related and what is uncertainty or crisis related? And there's some things that I can add about that. But there's a ton of geopolitical risk, and I think what's happening now is we're just more aware of it. And I think gold has, not to contradict you, but gold has done well because of that. The risk that I think that is the most important long term, and it's the slow-moving problem that's going to happen, is the death of the petrodollar. And for those of you looking for a gold standard, it's not going to happen, in my opinion. But there will be a transition. Here's what I'm getting at. In 1944, the United States, historically speaking, went to a gold standard because we had all the gold. Okay, in 1971, to pay for wars that we were in, we needed to inflate. We went off the gold standard. So we went to a dollar backed by fiat currency. 1974, the United States then approached Saudi Arabia and said, we want all oil to trade in dollars. So now you have a reserve currency, and that propped the dollar up. Okay. And then the Saudi Arabians bought arms from us too. Now, fast forward to now, paraphrasing Grant Williams, there are dots that need to be connected here. What I see happening slowly, and it will probably fall off a cliff when it does actually happen, is China wants to depeg from the dollar. They're liquidating United States dollars, FX reserves in the form of treasuries, okay? But China can't just say, we want the yuan to be the global reserve currency. China, there's going to be a transition, and that is related to the accumulation or storage of gold that the Chinese have. The Chinese are now dealing in oil with the Saudi Arabians in yuan. The Iranians are now dealing in oil with the Saudi Arabians. I'm sorry, with the Chinese in yuan. Russia is involved in this. So it's not a tinfoil hat concept here. The facts and the dots are out there that say China wants to get off the dollar. Okay, they're actually doing other things in the Caribbean and in Africa to get rid of their dollars, which I won't bore you with right now. But what they need to do is they need to inspire confidence before there's a petro yuan, for lack of a better word. And in order to do that, they need to have implicitly backed the yuan with gold. And so the crisis for the U.S. dollar, for the standard of living in the U.S., for America, for lack of a better word, is that eventually the demand for oil is in the Far East. The demand for gold is in the Far East. That's where the exchanges are going, and it will end with people saying, I trust Russia, believe it or not, and I trust China because they may not be backing their currencies with gold, but they've got a ton of it, and they can always confiscate it from their people with regards to China. China stores its gold with people or something like that. Yeah, and they're going to confiscate it too if they need it. So, I don't think that they have the smoothness down that our government does. But, what's going to happen, I believe, is the petrodollar will die as the golden yuan rises in trust. Saudi Arabia does not trust us anymore. They have their weapons. They don't want to deal with the price of U.S. shale, so they're going to be selling to China. They're going to be getting yuan in that, and then they're going to be putting that money into gold. It's the same thing we did, but gold is going to be the transitionary, I believe, fiat that allows the Chinese to say our currency's good. You're not going to see the IMF say, let's put gold in a basket of currencies. I don't think. That'll just cause chaos. But that is, I think, the global secular trend that is going to undermine the dollar. The decrease in need to keep dollars on your balance sheet to trade oil, the increase in need to keep other currencies on your balance sheet, and the fact that China is going to say, we got gold if you need it. And, you will not have a gold standard initiated in the West. You will have a de facto gold standard in the East, possibly. Okay? I see you shaking your head. It's opinion. That's all constructive for gold, I think. And all these other little fires that are going on, and some of them aren't little, they tend to get resolved. And anything that the gold market knows about as a crisis, it's not a crisis. Okay. That's why Brexit worked, because no one knew about it.
Let me jump over you a second, Rick, if I may. Matthew, if I may call you Matthew.
Mike.
Mike, sorry. Well,
I got a brother named Matthew.
I won't call you Matthew then.
But worse than the trading pits.
Yeah, on the Bloomberg terminal, you go into a lot of great detail on the different markets, gold included. You go into a lot of great detail on gold, on the fundamentals. How important do you think the supply-demand fundamentals for gold are?
Well, that's one thing I enjoyed about the previous panel. They're almost insignificant. Because gold's not a commodity. It's a currency, as we all know. And I need to clarify that. My job at Bloomberg is putting all the commodities together in one big space as measured by the Bloomberg Commodity Index. And the biggest component is gold, but it's not, I don't look at it as like I'm measuring supply and demand in corn and copper. It's not the mining supply of gold is completely insignificant. What really matters doing the historical analysis, what I try to do on the terminal is I think it's my fiduciary duty to people understand what really impacts markets and makes things flows. And the number one thing for gold is Vince said earlier, it's inflation. And what the Fed does, they chase inflation. So number one, gold has actually always performed better in tightening cycles than easing cycles. Why? Because they're tightening, because they're chasing inflation. And do you think they're going to try to be ahead of inflation this time? Unlikely. So I look at, in fact, I have a fellow analyst who's a fundamental analyst, and I'm a strategist who put out a piece on gold and the fundamentals lately, and I just didn't even read it. Because I look at the dollar, it's that debasement of the currency. The number historical factor almost every time, everywhere, is the value of the currency. Again, it's how you measure it. That's the number one way to a factor on the dollar price of gold. So, and how do you bring on supply in gold? Higher prices, scrap. I mean, as Rick's nodding, I've heard Rick say it before, higher prices bring in, I see it in silver a lot, definitely silver. Low prices, there's actually virtually no reason to be scrapping now, and virtually all the little silver you see now goes in these little electronic devices, too expensive to recycle. But price goes up, we'll see some supply, and it should be more of a when, because that's how, I mean, sure, the mining supply will react with maybe a 5 to 10 year lag, but it's got to be from recycling for supply. But from demand, we all know that will impact the price of increased demand for gold. And it's not ETFs. That's one thing I've enjoyed doing the analysis of. There's a complete, the ETF flows follow the performance of gold. And I've looked at this a week after the gold moves, and ETF flows into precious metals, follows it with a correlation of 0.7 or so. Now, when they got started, it was the other way around. But that's when things really changed. So I see there's some other fellow analysis. Oh, there was a massive outflows in gold ETFs. I'm like, yeah, well, you look at the price last week, it was down. So I think that's my time.
No, very good. And Rick, can I call you Robert? No.
Again, I've been called worse.
Last question before we open it up. If you have a sort of 2 to 3 year time horizon, is this a good time to be buying gold, do you think?
I hate answering a question like this, but I have no earthly idea. If you gave me 5 years, I think the answer would definitely be yes. But, you know, I buy gold, but I buy it for insurance purposes. Okay. For Alpha, I buy gold stocks, and I try and buy them because they're better gold stocks than the other ones. And you're asking me a question that's above my pay grade.
Okay, let's see if someone in the audience has a question that Rick can answer. Let's start here, and then we've got 2 at the back. There's a microphone coming.
Okay. I'd like to challenge you on the. Thank you. I'd like to challenge you on the question that you raised about Petro One and maybe Gold One. I'm wondering if there isn't a transitional step from euro gold or dollar gold to SDRs, because I think the political risk involved for China of making such a precipitous move so quickly can be mitigated by hiding under under the SDRs and the Bank of International Settlements currency as a way of moving forwards. I still think that it's all about transaction velocity. And so to the extent that, as you mentioned, Iran, Russia are all going to trade in less dollars and more something else, probably SDRs and yuan and whatever, to the extent that you have a decline in money velocity or transaction velocity, that's, I think, what's really going to catch people's attention and accelerate that move. Comment.
So the question is, or the challenge is you think there would be...
My challenge is the SDR.
Okay. First of all, with your comment to the speed of a transition, you know, from assuming that I'm right for the moment, right? The speed has to be slow. It has to be glacial. It has to be subtle until it's too late. With regards to SDRs, the IMF well, first of all, there is something better than gold, and it's not going to happen for the dollar, and that would be a trade-weighted dollar in an SDR, and you're not going to see that. So what will the SDR be comprised of? Well, it's going to have the yuan in it. These are synthetic current. I'm sorry. Go ahead.
It will be comprised of whatever the most amount is traded in, so that if indeed today it's 50% dollars, and in 5 years it's 30% dollars, then the SDR will adjust itself, so there will be less dollars and more yuan or whatever.
Absolutely. I don't disagree with that at all. In fact, there was an adjustment for the yuan, even though the U.S. dollar did not suffer proportionally the way I think it should have, or give up enough ground. It's all bearish for the dollar. Or dollar-denominated gold, it's bullish. So can it happen slower? Can there be an intermediate step? I don't know that the SDR is planned to go in, but I think it's the panic button if they have to. I mean, that is the role in many ways of the IMF. I mean, frankly, the SDR is a virtual currency of virtual currencies. And, so I've insulted it, fine. But the reality is, they can make it happen. And it can happen. And it might happen. But I don't think gold will be in the SDR.
Okay. There were two people at the back. Not together, please.
A comment on the introduction. It seems that the biggest effect of the previous administration on Trump is Obamacare, and the fact that if a small business goes beyond whatever the number is, 6 or 10 people, it has to start paying massive health insurance for them. And this has restrained the economy in a way that I don't think anyone has realized. And the second point is the yuan will never be a reserve currency. It will be in the SDR, that's it, because the Chinese will never free up their economy. And if you don't have a free economy with price discovery, to your point, it cannot be a replacement for the dollar.
Anybody want to comment on that? Yeah, I certainly agree with you on Obamacare.
The Obamacare is a joke. I mean, that has been the biggest destruction, but that goes right back to the free markets. When you can only have one insurance company in a state, what are they going to do? And they're all saying, well, we're not making any money, but I look at their stocks, they keep going up. It's an amazing anomaly when you watch this. But Obamacare, the whole situation is a joke, and if they want to insure everybody and all the pre-existing, then take it out of the entitlement programs and let the roll take over.
Absolutely.
And as they roll out, then everybody who's young should then be in. So there wouldn't be the pre-existing condition deal. The whole situation is a fantasy land of what they thought they were doing, but they were really trying to get to single-payer insurance, which is another crock. Okay, we can't. The whole Fed system, the whole government system, is designed to take from the middle class and basically destruct them, and that's what they've done. They've been very successful at ruining small business and tearing apart the country and the economy. And until we get away from that, which I think that's the idea of Trump, even with the infrastructure, he wanted to borrow $2 trillion to rebuild. You put those people back to work, they're going to spend money. Right now, they're not working. So right now, you have zero.
Gentlemen, I want to ask you, just to switch a slightly different topic for a moment. I want to ask you about human psychology. The markets, from what I'm boiling it down to right now, are a function of human nature, which is largely a function of psychology. I've done some reading from history of the bull market in the 1970s that led up to 1980. I was not there, but from what I've read, the psychology of the markets at that time was clearly exhibiting bubble-like characteristics. Apparently, there were people lined up outside coin shops and city blocks and some other specific things. From my observation in 2011, we did not see similar bubble characteristics. But I want to ask you gentlemen, because I want to know from people, if you lived through it in a way in the late 70s through 1980, did we experience the same human psychology in 2011? Is it possible that we missed that there was another bubble?
I guess the oldest guy on the panel gets this question. I don't think so, right? Well, I lived through the 70s. I made fun of myself this morning saying that I happened to be in the resource business then, and I confused a bull market with brains. I thought that move that occurred in the 70s happened because I was a smart guy, and that's certainly evidence of a bull market. Hubris is probably an indicator of a bubble. I don't think that the set of circumstances that upset people in 2011 took long enough to unfold. My experience in the context of the psychology that you describe is that your expectation is formed by your experience in the immediate past. And the inflationary expectation that was built up, or was manifest, pardon me, in the decade of the 70s really began to exist in the latter part of the middle 60s, the sort of guns and butter era, when our government decided that they could have their cake and eat it, or ours too. It took a while to build the expectation of inflation into the market, and the interesting test for that, of course, was 1975, when interest rates tightened, the U.S. dollar went up, and gold fell by 50%. It fell like a dollar, like a boulder off a bridge. And the consequence of that was that there was enough expectation in the market, and also the fiscal response to the tightening was loose, that the expectation came back in earnest. I don't think that the experiences that we've had since have been long enough. The second thing, I think, is that there's so much liquidity in the system now. And my suspicion is that that liquidity is the ultimate soporific. The fact that people are insolvent doesn't matter to them in the near term if they're liquid. Somebody who owes $1 million that has $10,000 in his pocket can still buy a couple of bottles of beer and be happy. And this incredible liquidity that we see, I think, is partially responsible for a VIX that's just somnolescent. And I think until something happens that scares people to the extent that they get past the soporific effect of the liquidity, we won't go back to the sort of mindset that we saw in the 70s. I'm making this all up, by the way.
You're doing a great job.
I'm actually a loan shark, not an economist or a psychologist.
I lived through both, and I think that the recent one was just as good, just as big, because now in today's world we move a lot faster. You know, there's information flows faster, crashes happen faster, the whole thing. Now, all I remember of 2010, 11, and 12 is every corner was a gold store. They kept opening them up. You can go look at all the empty ones right now. But they just happened faster. Well, am I right or wrong? Did they not open them everywhere? Everybody was buying gold.
But yeah, they were buying the gold. That's not a sign of a manic bubble for people.
Well, sure it is.
Gold. They were selling gold.
They were exactly.
People
But
were
we
gold.
pushed it out. Listen, I remember I was on with Jim Cramer on CNBC the day the gold hit the high, and he's going, buy, buy, buy. And he says, you're nuts. This is a bubble. And, of course, it popped. But the point is that everything flows so much faster now that collapses and crashes and bubbles that are built, and in the 70s, we weren't being determined by, again, back to my favorite, the Federal Reserve, of building the bubble and bringing interest rates down for 37 years, making the longest bull market in history. They should.
Adrian, if you can go back to the chart that you had on there from the chart from Liechtenstein.
Are you able to put that back up? They can't put it back up. Oh, in a minute they can. Okay.
So you said that you can't predict inflation. It's not like a thermostat. But the examples you gave were from like 100 years ago, 70 years ago, 45 years ago, after World War I, World War II, Vietnam. Why would you think that's applicable today? I mean, it's an entirely different set of circumstances. Even Alan Greenspan said that the Fed has better control of all these inflation, et cetera.
Well, I don't know about even Alan Greenspan, because I don't think Alan Greenspan is quite the maestro that people seem to think he was. I guess I'm a historian, and so, by training, even though I went to the London School of Economics, I'm a historian, and you know, to me, looking back at what's happened over 100 years is not irrelevant. You know, because people are the same, people react to things the same. I understand those two were wars, and I understand.
And the third one too, Vietnam.
Well, yeah, not quite the same, but yeah. But the point I think I'm making is that when you look at examples of high inflation, inflation tends to move up slowly and then start to move parabolically. And you can see that in many examples in many countries over the years. So these are extreme cases. Maybe I should look at less extreme cases. But I think the truth that inflation moves exponentially when it gets going, and it's very difficult to control. It's very difficult to control inflation without drastic action, like bringing in a Volcker. You know, that controlled inflation pretty dramatically. But I don't see anything like that on the horizon at the moment, and nobody thinks inflation is a problem at the moment.
Can I add something to that, if you don't mind?
Yes, please.
I think I grasp your point in the sense that these could be the exceptions, not the rule. But to me, this says, and I'm not sure the causation or the correlation and causation, whether it be war or not war. But you know, I think what I see here is you may be able to have a more smooth thermostat-like control of inflation most of the time, but it's going to surprise you, and it usually surprises you when interest rates, when people start to say, "Oh, we really aren't doing enough to keep up with rates," right before Volcker comes in, and then you get that Giffen good effect where people chase harder for the less money that's around, and then you have your spikes. So I don't know if that correlates with the war situations.
Tell them what a Giffen good is.
Gold is a Giffen good, by the way. A Giffen good is like perfume. The higher it goes in price, the more people want it, at least for a period of time. So he made me say that. Everybody here knows what that is. Like options. You trade options, right, Mike? Yeah. Options are a Giffen good. So I think in general you have smoothness and then you have fits, and I think these are good examples of predictability works until it doesn't work.
Any other questions? I know we have to close pretty soon, but anybody else have one? Yes, sir.
Some of us are old enough to think about a shovel and a bag of dollars or gold, but maybe the young generation think today is gold versus Bitcoin. And so then the question is Bitcoin just about transactions, opaqueness, or is it really about a substitute for gold over the long term, and is it taking market share from gold?
That's an interesting question.
Well, I've done a little bit of analysis on that, and in fact, it's one of those things when I like, again, it's unique where I sit, is I get a sense for what people are interested in. So if I put Bitcoin in any of my titles, I get thousands of hits. If I put cotton in, no one cares. So I've done that, and to me, Bitcoin to me is about, I don't care about Bitcoin so much other than I care about gold. Gold's a commodity. Bitcoin's, well, gold's a currency, but it's to me, it's the gold is a quintessential alternative asset, liquid alt, is the way I see it. And Bitcoin is one of the up-and-coming liquid alts. So the way I've done it, I've seen the analysis is it's kind of unique to me that Bitcoin's taken off and gold has dropped, because lately, this is the second time Bitcoin has surpassed the price of gold, and the last time it got near, gold just bottomed around 1,200 and went to actually it was around 1,300 and went to 1,400. So I view it as a demand pull force for gold, an indication of demand for gold, is the way I see it. But one thing I wanted to finish with, if we have a closing remark, is the way I look at gold is I hope it goes down the next few years in my portfolio, our portfolios, because for the reasons that it went down for the last 5 years. But I suspect it's not going to. That's the way I think we should look at it, and I think Rick agrees with that. Because the trends I see are there's times of overweight and underweight, and this is probably more of an overweight time based on the divergence you've seen. Bitcoin's an example. You should be more overweighting gold versus, when you were on with Kramer, and that's a sign. Okay, maybe I should start underweighting. I mean, that's the way I see it. And the final thing I say is, speaking to my son about this subject, he's a Marine Corps sniper scout. These people who buy physical gold, I get that, but his quote was, "I think I'd rather have a gun and some ammo."
No. Just I want to say something on that Bitcoin. I think that it is taking share away. I think the privacy of Bitcoin makes people more comfortable. It's easier to get it, like when there was problems in Greece. You couldn't get out your money out. You can get it out through Bitcoin. I'm not a big fan, but what I do see is when you go online, if you look at some of the poker sites or you look at some of the gambling sites, they only function in Bitcoin. You can't go on unless you put Bitcoin. I have an employee that works for me that will only be paid in Bitcoin. So people want that privacy because they know of what can happen. I'm not necessarily agreeing with them, but that's why I see the Bitcoin continuing to move forward. And the technology, Macy's takes Bitcoin, Priceline takes Bitcoin, Overstock.com takes Bitcoin. You've got that blockchain technology. People take it now as a currency.
Todd, if it's electronic, how can it be private? Versus gold, you can put it away in. I don't see how it can
I
be
understand
private.
it, but if you put gold with a third party, which most people do, they can take that too, can't they? If I put gold in my safe, they're not going to get
Anything that's
it.
electronic is a permanent record. Anytime it's transacted.
Well,
Versus-
but
that's
you
why-
don't declare it on your taxes.
Well, if I
You
buy something from Overstock that delivers it to my address, it's pretty clear, and was paid for in Bitcoin, it's pretty clear where the Bitcoin came from.
I can certainly understand that. But again, the point is that you can store more with less knowledge. It's like a restaurant dealing in cash. I can put the cash in my pocket. The government doesn't know how much I churn through that restaurant. They don't know that I have one register off all the time. That doesn't count. So, I mean, again, there's always a way around it, but people have the appearance that they want to have that privacy. They don't want to show and maybe pay taxes or whatever. And that's, I think, the allure to the Bitcoin.
Okay. Do you two have closing comments? Are you coming up? Do you have closing comments?
Can I add to the
Sure,
Bitcoin?
of course. You can close your comment on anything
There you
you
go.
want.
Bitcoin is electronic. It offers privacy. It'll be demonized. Laws will be changed because it is electronic and it can't be held or stored. I see you as both right. The technology behind Bitcoin, blockchain, will be co-opted by corporations. If money becomes fully electronic and digitized without any clearing risk, which is what banks want, which is what the technology of blockchain is, which is what Bitcoin will, as the first in, will probably be the first outlawed because criminals use it or whatever. So Bitcoin competes with gold. In the end, it's electronic, so there is a track record from it. And until they QSIP your gold, which they will try to, and try and force you to put it into a bank and then lend you money against your own gold, gold is storable, Bitcoin is not. But, it's a war. And the war is between, hiding and not hiding, kind of like, guns and defense. So Bitcoin will be outdated, something else will come along. But blockchain is here to stay. And I think that's part of it.
I agree with you 100%. They will figure out a way, and the whole issue is with everything. Everything that was once illegal or against everybody's principles, when they can figure out how to get their share, it magically becomes legal. We're watching that with pot right now going out throughout the country. It's magically becoming legal because they found a way to tax it. That's the whole deal.
Rick, do you have a closing comment?
I wasn't gonna. I was going to give people a break, but when people started talking about gold and Bitcoin, that gives me an opportunity for a commercial. Sprada's working with the Flash Boys folks here in New York to make a blockchain-cleared gold token. We figure if somebody's going to disrupt our gold business, it may as well be us. And so perhaps at Mines and Money in New York next year, we can talk about a blockchain-cleared gold token. At least I hope so. Thank you.
Okay, well, that sounds interesting. I'd like to thank the audience, first of all, for bearing with us. I'd like to thank Mike, Rick, Vince, Todd. Thank you very much, and thank you for all your comments. It was interesting, and thank you, ladies and gentlemen. Are you coming up?
Thank you very much, and thank you to Adrian, and then thank you to all the speakers here for the afternoon session. We're now going to break for a drinks reception taking place in the exhibition room. So look forward to seeing you there in a few minutes' time. Thank you very much.